Now, Dr. Kigonyo told us about legacy, the importance of legacy, and Ken Odenyo told us that we should not just cruise through life. Then Dr. Gashora has also told us about how to be resilient and protection so that we don't lose our money, and Raphael also told us about those macroeconomic factors. Now, I want us to talk a little bit about that resilient portfolio and the whole dynamic around it. You know, in my media practice, I come across stories every other month about people who are battling in courts over their family wealth, and we're wondering, these are families that seemed intact. So the matriarch, the patriarch goes and things fall apart. So I really want us to understand how we cannot be part of that statistic. And so I'd like to start this conversation with you, Peter. Kindly just give us an overview of what the state of family wealth is in Kenya, and then we'll pick it up from there.
Thank you very much, Claire, and thank you, Abojani, for having us. This is a fantastic conference. Really a pleasure to be here. Family wealth challenges and the battles in court have been quite interesting. Kenya is just slightly over 60 years old, and we are going through the 60-year-old challenges. So the scope of wealth that is being fought for in court can really be vast. Let me give you a context. By 2018, in Nairobi High Court alone, there were more than 13,000 family succession cases ongoing. Mm-hmm. And you can imagine now, if you extrapolate that across the country, across the 47 counties, and given that there are, you know, different levels of, you know, fights that goes, it can be in probably hundreds of thousands of battles that are going on. In terms of the quantum of the wealth that is in contention, it probably may in hundreds of billions or possibly trillions. Case in point, right now we are talking about unclaimed financial assets, which are part of the battles that are being, you know, most families are struggling with, close to 80 billion Kenya shillings. And those are just financial assets. Now, think about the amount of wealth in family businesses, in, you know, hard assets that is now being contested to be passed down the generation line. So it's a serious conversation that I think it is an apt moment for us to have a conversation around. Besides just building the wealth, how do we protect this wealth? And how do we create effective structures to pass it down the generation line?
Okay, so maybe before we get down to some of those tools that we can help us really build those resilience tools, tell us a little bit about what is causing these kind of problems. 13,000 cases. Why are people battling for succession matters? And then we will talk about the tools that we can use to make sure that we are passing on a good legacy to the next generation.
Claire, you may be surprised to know that challenges in succession planning, passing down the wealth, has nothing to do with the wealth itself. It actually has to do with a lot of other soft issues. I was very interested and very happy to hear Daktari's conversation about how the current hospital journey is being passed down the generation line. I mean, you could see a son, a grandchild. Those are some of the things that we probably need to take more seriously. So there are specific aspects that have been picked up in statistics on challenges that cause failures in succession wealth transition. The biggest is areas around communication and trusts within families, followed very closely by challenges around failure to train the recipients of this wealth. I think part of our culture has been that we want to go out there, hustle, create all the wealth, but my child has no idea what I am doing. They have no idea how to pick up if I hand over the family business, the wealth to them. How do I, besides passing on the assets, how do I also pass on the knowledge? Those are some of the things that we need to pick up. And also, a very important conversation that we need to start thinking around is establishing a vision, a family mission, and a family vision. It was also, again, very interesting to hear Daktari talking about a vision that had been created many years past. And in his talk, you could actually see that that idea, that vision, is being passed down the generational line. How do we set up structures that will facilitate that vision transfer, that knowledge, that idea that can be bloomed down the generational line? Those are some of the things that I think would be really critical to build.
Okay, thanks for that. Now we'll get down to the financial tools and non-financial tools, but I'd like to rope in Elizabeth a little bit. Before we have something to pass on to the next generation, we actually have to build that wealth. So maybe you can give us a little picture of what the state is in Kenya when it comes to wealth management.
All right, and good afternoon, everybody. State of wealth management. I think it's very, we're in a good space in terms of knowledge as in today. Years back, this conversation would have been like really, really far out. So I'm really excited that today, as we sit as investment managers, the conversations are so bespoke, they are real, people are looking for the right, they're talking the right conversations about their monies. We are not just talking plots. There's a time I used to preach, what is this about plots, kamulu, what, that one. Why? Why, guys? Why? So I'm really glad that these days, the conversations when you meet with, whether it's young people, whether it's an older person, they're gravitating more towards financial assets or a mix of portfolio, which is very good. We don't have statistics. That's the next thing that we need to do. We don't have clear statistics that can show you Kenyans are investing in this style. But just going by some modest, not very clean statistics, we can say, for example, when you look at bonds, just look at what the Dow CSD has done. The number of people who have registered in the Dow CSD is an indicator of the grasp of alternative fixed income assets that you can buy. Then you look at the collective investment schemes. Here we still have an issue, but look at the growth of the assets under management. Some 2 years ago, we were just at 100 billion. Today, we are at over 300 billion, 3 times bigger. It's not like the greatest for a population of 50 million people, but it is a right trend. It's a right direction. We are making good moves around taking up collective investment scheme. My worry there is we are still stuck with guaranteed returns. We want things that don't fluctuate. So all of us are buying money market funds. Just that. And we are very happy with ourselves and we are like, I can still put until retirement, my friend. I don't think that's really nice. We need now to start, after buying money market fund, you need to explore the next asset class. You can't stay in money market fund. And I see young people here. I will dissuade you from just picking money market fund, but it's a nice place to start, but not a destination. If you make it a destination, we compromise our future. We compromise the growth of our nation because we will not be able to invest in long-term assets as a nation. We will not unlock the potential of our country because all the assets are being invested in very, very low-risk investment, and ultimately, then the capital is not getting to the real sector. It needs to get to the real sector. That's a lot of economics. Then we go to other asset classes like mortgages. We've seen a good rise in number of mortgages. For a long time, we were 24K. Now we are speaking about maybe more than double that amount. Affordable housing has come. I think, Claire, the direction is good. Are we at a destination? No, but we are caught in a place where I say it's great place because we will witness the change ourselves. We will live to say, we saw this tide moving, we saw it changing. So we are part of history and a very great history for our nation.
Okay, so yeah, you've talked about people wanting guaranteed fund. No one wants to burn their fingers. And you know, Gashora told us how he lost money, stocks. We don't want to be another statistic there. And you said, good people have moved from the plots, yeah? People had 10 plots here, Kamulu, there, Joska, Nyanyuki. So what does a balanced, resilient portfolio look like so that we're not taking too much risk, but at the same time, we're not just there at the MMFs and not growing?
So when you talk about a balanced, resilient portfolio, I'd say it's when you think about your wealth holistically, not in envelopes. You need to look at your wealth holistically so that you make sure that first and foremost, you have a solid base which can support you in the event of an emergency. That's a must. That's a must, because then you can get very frustrated if you only have illiquid assets and an emergency comes and you can't. So the first base is always have something that you can be able to access at any one time in the event of an emergency. Then you've got to think your long-term goals, medium-term and long-term goals. Medium-term being objectives or goals such as maybe owning a home, building a home, and of course you can't build it today, you need to work towards it. So there you buy assets that maybe have a 5-year horizon, not a money market fund, especially if you say, when I'm 30, I want to put my deposit for my first house. Probably don't put just in money market, try and mix a bond fund, a fixed income fund, and a little bit of equities so that you can reach that destination faster. Then you've got the retirement, the things that we don't like thinking about, especially when you're young. Retirement, you're like, that's for the old. I don't want to think about it. I'm just 20s. Life is it's for now. I think there's a YOLO and all that. You've got to think about it. You've got to think actively about what will you live on when you're 70. Yes, you will work towards growing your incomes in your career or in your business, but even your assets have to be part of it. So you grow self, but you also plan around it. So if you're not part of the mandatory pension contributions, you've got to start a pension account. You have to start it, maybe not with a lot of money, a small amount, but it means a lot because of the time value of money. So that's kind of resilient portfolio you want. Then your plot will still come in that whole mix. Your plot will come in. It will not miss a place, but it can't be the destination. Is a car part of that portfolio? It can be. It can be, because you've also got to live today. So, but is it something you need to borrow so that you own the car? Probably not. You need to think about it in a more careful manner.
Okay, thanks. So just that holistic thinking. Now, Peter, I'll come back to you in a few minutes, but I'd like us to talk a little bit about digital adoption. Elizabeth, you talked about DAO CSD. It's just been a game changer. And I'd like to rope in Rose on this. I'd like you to tell us, you're the director of a neobank. First of all, what is a neobank for those who don't know? And then also talk to us about where we are in Kenya in terms of adoption of digital solutions when it comes to the financial sector.
Right, good afternoon, everyone. So it's really great to be here. I'm really excited, and thanks to the Abojani team for inviting us as branch. So for the benefit of the people in the room, the ones who are not aware of what a neobank is, it essentially means we don't have any branches, we don't have any physical presence. We exist purely on an app, and our app is called Branch, so you feel free to download it at any point in time. So to the question, where are we? So I would look at Kenya as, that student who will always tell you, or your friend, I haven't done that assignment, or I haven't read for that exam, but then they go in and they pass. So they're busy telling you, you believe their story. So sometimes I look at us as, we are those A students when it comes to digital adoption. We did very well when it comes to things like mobile money. We were, the whole world was cheering for us. But now, what is the next phase? These are now the assignments we haven't completed. This means we've done the basics. We've allowed people to instantly, digitally send money across. We've allowed people to instantly and digitally save money. But we haven't gotten to the part where we are helping people to build wealth. So there you're looking at, we have lots of fantastic products in the market, but we still are not there yet when it comes to the adoption. Today, when you talk about the wealth, I think it was trillions that were being spoken about earlier today, it is just a finite group of people that are doing that. If you look at the number of people in this room and the wealth that you're building versus the population that we have in Kenya, there's a disparity. So we still need to get to that next level where we're saying, let's now commit as a country that's doing very well in terms of digital adoption to now build wealth, to now enable Kenyans to actually be able to do more sophisticated type of savings, type of investments. So what I can say is, even for small businesses, we've enabled them to get cash flow. Today, if you want to get a small loan, it's pretty easy because systems are there, it's all digital. We sometimes don't even need to ask you for any documentation. But what about the next level? What about, I can see the 100 million challenge for SMEs. And I'm sure through the day we'll get to learn how will you be able to get to that level as an SME. It may sound audacious, it may sound big and hairy, but what tools are going to help you to get to that level without causing you panic or unnecessary sleepless nights? Because, you know, collectively as financial or digital financial providers, we're helping you to get there. So that being said, I think what we can look at is moving the population from surviving, and that's what we were told about earlier. And we normally say it, we're probably just one illness away from poverty. And not necessarily your illness, it's just a family member. You're, you know, one predicament away from poverty. So how do we move from surviving to thriving? And I'm pretty sure the experts in this group can actually help us to unpack that. And we can, you know, rest in knowing that we have this Ferrari because everyone here has fantastic products and we can use it. Because the frustrating bit is like, you have that fantastic car, but you're not even shifting gears. We're just there in these fantastic Nairobi roads. You can't shift gear, you can't move quickly, but you have a very, very good vehicle. So I think that's where I can say we are.
Okay, thanks. And Esther, I'll come to you in a bit just to talk a little bit more about the financial services and that disparity. But I'll go back to you, Peter, to talk a little bit more about those financial and non-financial tools that we can use when it comes to succession. You know, Rose has just said that we don't want to be surviving, we want to thrive. So how do we make sure that our families are thriving? We don't leave them in a mess once something happens, because as we've heard, life has risks. So how do we use financial and non-financial tools to make sure that we are set for the future?
Thank you, Claire. So as you said, some of these may not necessarily be financial tools. It's actually structural tools. Because when you're talking about, you know, staying wealth or generational transition, you're actually trying to sort out two key challenges. You're trying to sort out the challenge of wealth ownership across generations, but you're also trying to sort out the issue of how do you do the transition across generations. There are only two ways in which you can handle estate transition. You're either doing a will or you're doing a trust. From a structural perspective, those are the only two ways. We have experienced some families who have set up family companies and consolidated all their wealth within that family company. The challenge with that is that that company is still in shareholding. So you'd still need to succeed that shareholding. So it basically doesn't become the end in it. It doesn't create that transitionally structure. And that's why a will would sort out the distribution to the next generation. But in most cases, we are seeing scenarios where the challenge and the desire may not be to distribute. It may be to preserve. Because if I run an enterprise that I have grown to a certain level and I have several heirs that I need to pass down that enterprise to, it may be very complex to actually subdivide that and pass it down the generation line. And that's where now a trust comes in. Because what a trust basically is that you're creating a legal person that can own the assets on your behalf. And because that legal person is an immortal person, they can continue to own across generations. And then now you convert the beneficiaries to be now beneficial owners, and they continue to now benefit across generations. That's a structural part of it. And it's very effective because it actually achieves the purpose that you want to be. But as I said earlier, the conversation is beyond structures. We have seen now a very practical conversation that also connects these other soft requirements that families have that I talked about as the greatest risk that families are trying to sort out. So we have seen solutions around passing down the generational wealth knowledge. You know, we, like Dr. talked about, how do we inculcate apprenticeship within wealth preservation? By making sure that you do not start training your child on how to build this wealth when they are in their 50s. By that time, probably their minds have already moved on to other desires. How do you incorporate them from, you know, from childhood? And you help them to get to understand, how do you hold a business meeting? Who are the business partners that are part of your enterprise? How do you help to train your child to start building that money market that Elizabeth was talking about, from as early as when they can start to understand finance? But also, how do you inculcate elements of the value system that you want to pass down the generation line? We have seen tools like a family constitution becoming very critical in succession planning, because you're basically building a value system that can be written down, that can be grown across the generational line. So that it becomes now a living vision that you're passing down, you're building and growing and maturing, and it can actually now transcend one generation to the other.
Wow, family constitution. How many of you have a family constitution? Food for thought there, Peter. But Esther, Mama Mpesa, I'd like us to talk a little bit about digital adoption. And Mpesa has more than 30 million customers. So maybe you could tell us about what that journey has been when it comes to financial inclusion and financial empowerment.
So thank you and good afternoon, everyone. So the story, I think we all know the story of Mpesa, how it started. And digital literacy has been a very big part of it, to make sure that people adopt Mpesa. For those of you who were born post Mpesa came into play, I was born slightly before Mpesa came into play. I'll just give you a little story. When I was in university, I was up in university in Baraton, University of Eastern Africa, up in Kapsabet. And when my parents needed to send me pocket money, I used to get money by what you call a postal order. Do any of you guys know what a postal order? Okay, I can see a few. It's a note that you get that you need to go to the post office with your ID, present yourself, and you get money out, right? And so that's how I had my university. Then Mpesa was birthed or born 2007. So it's about 17 years old now. So what has happened since that time, since when Mpesa was birthed until now? Mpesa was done to be a tool that you could send money back home. The rationale was that a lot of us work in the cities and we want to send money back home. So that's how it started. So we're sending money shags. We're trying to eliminate Akamba. We're trying to eliminate the postal order. And it transformed completely. It no longer became a tool that you're using to send money back home, but it became a means of engaging and transacting. But that was on the back of a very powerful telecommunications ecosystem. If we didn't have the ability to communicate, the ability to use data, this would not have been possible. In fact, one of the things was, let's do this so that we can keep people active on our network. But it created another way of working. I mean, today, I have not touched money for a long time, physical money. And I have teenage daughters, and when they're going out and I need to give them, money to go out, I say, can I give you cash? They're like, no, Mom, cash is of less value than Mpesa. So that's the transition we've gone to. So from postal order to Akamba to now transacting and purely becoming digital. But these tools have all been enabled by purely a connectivity system, which is what telecommunications has been able to do for us. And now it's become a way of life. It's become a tool of trade. Today, about 2/3 of the Kenyan GDP actually goes through Mpesa. 2/3 of the GDP. The financial inclusion that Raphael spoke about, the 86%, it's because people have access using mobile money. it's accelerated that. And I was a banker, and once you're a banker, I don't think it ever goes away. But as banks, we always struggled to make sure we could get more and more customers. So convenience is what has actually gotten people. The fact that it's instant, the fact that you can see it's Esther who has sent money to John, as an example, and you can see it right there and then. You don't need to understand much. You don't need to have a lot of financial literacy. You just need to know how to use your tool of trade, which is a phone, which is now where the literacy starts to come. We've gone into the era of mobile data. Today, if the Wi-Fi is down or we have an interruption of mobile data, there'll be a big issue. There'll be a riot. Now that's a way of life. So that's how we're seeing that. Digital literacy has become a way of life. Everyone is tweeting here. Either we're going on Instagram. For those who have entrepreneurs, your businesses are all on Instagram. They're on a website. You're reaching people in this way. That's part of digital literacy. And it's becoming more and more prevalent. Some of the things that I'll give you an example for businesses that we support, especially medium, small businesses, is we've given you a till, a virtual wallet, Lipa na Mpesa, your pay bill. You're able to then do your reconciliation, because what is business about? You need to be able to track what's coming in, and you need to be able to track what's going out. I doubt that any of you guys who are using a ledger book, it shows you again how old I am a little bit, but none of you is doing an entry in to say this I collected. It's actually all on your phone. One of the biggest demands that we get from a customer experience point of view is people want to see their statement. Why do they want to see their statement on Mpesa? It's one of the tools that we provide to you. It's because you want to be able to do your reconciliation. You want to be able to plan and say, how much do I have so I can make the next purchase? How much do I have so I can make the next investment? And so that's the role of digital literacy. So it's happening slowly. I don't even believe that you feel that you're being digitized. But because of those steps that we've taken, today at least 70% of MSMEs in this country are digitized by simple actions of being able to keep records. I think Peter spoke about families and how wealth is passed on. Wealth can only be passed on if you have clear records. Even as Mpesa today, you'll be surprised, but we submit billions back to the Unclaimed Financial Assets Authority. And why is that? Because people keep money in their wallets. You don't tell anyone, which is good. You shouldn't tell anyone. Siriako, Piniako, all of that, it's important. But at the same time, we need to be able to ensure that this is being passed on and you're checking in on a regular basis to see how your wealth is growing. And so partnerships also becomes really key in terms of driving financial literacy. We're not running Mpesa alone. We've got partners. I'm glad to see NCBA here is one of our largest partners. Where they're not able to lend money. Yeah, we're able to extend credit. So in that moment, when you need to make a quick payment and you're just short of funds, you're able to make a payment. That's borrowing, right? But it's borrowing with a purpose. You're completing a transaction. For your business, you're buying stock. For a mom who's in the store, you're able to get the needs that you require. So that's how we're transcending digital literacy into financial literacy. And so being able to understand that you need to use money appropriately when you're borrowing, to also saving. How many of you here are saving with Mshwari, at least? Yeah? Okay, we've seen some. How many are saving here also with KCB Mpesa? That's another tool that's available. So it allows you to put money away. It may not be, and I know we've been urged not to just look at money markets and deposits, but for that rainy day, at least you've got somewhere you can go and be able to collect money. And then you're also building your credit profile. Then I'll know you're a good, you're able to transact, you're able to save, and you're able to pay back. So you're building a credit history, which is a very big part around economic empowerment. Because how do you tell your story as an individual? How do you tell your story as a business that you are powerful, that you're able to repay, you're able to, collect? That's the data that we look for, and data is really important. So I'll encourage all of you, with the Mpesa that you're using, look at your statement. It'll shock you at how much money you turn over in a year. Yeah? It'll shock you how much money you can potentially save. Those are all very important data points, because when you're thinking about your big vision or your big mission around what you want to do in the next 5 to 10 years, it can only be informed by what you're able to do today. And if there's a shock today, you need to know where to cut. If you don't know where to cut your money when a shock happens, then you're truly shocked. You're truly shocked because life will be really difficult. So use the digital tools that you have today, and they're at your disposal, to start to plan and think about, what is it that I want in the long term? What am I truly worth? Some of you are really here underestimating your worth. Just look at how much you're able to transact. January to December. December is coming. December is coming. And you'll be shocked that December is the highest transaction volume and value month in this country. But you're all saying you're broke. Yeah? Christmas, we see you. We see you because the money comes out. And so all I'm encouraging you is look at your statements, build a way of just doing analysis, understand where it's going so that you can then build this wonderful mission. But that can only be enabled through, of course, use of data, use of digital tools like Mpesa to be able to give you these insights.
Okay, thanks. And we'll talk a little bit more about leveraging on these digital financial tools. But Robert, I'd like us to talk a little bit more about MSMEs and SMEs. You do hard things at HF Group.
Yep.
And if you don't know what that means, talk to Robert after this. It's an inside joke. Now, first tell us a little bit more about the state of MSMEs and SMEs in Kenya right now. Then we'll go to how we can sort out these challenges.
Okay, thank you. Thank you very much for having us. Good afternoon, everyone. So if you look at SMEs in Kenya, especially around the area of financing for SMEs, first of all, SMEs contribute a huge value in this country. They contribute to 24% of our GDP. But actually, I think they are the forgotten lot. Because if you look at the level of financing, there is a study that says there is a gap of 2.7 trillion shillings in terms of the financing gap for SMEs. And actually, FSD has done another study that every year, that gap is about or increases by about 130 billion shillings. And what causes that? There are several reasons. Some of them caused by the environment itself, but another part by the market itself, the SMEs themselves. So if you look at, for instance, the gap itself, so there are interventions that have come. Obviously, banks, the other day, our chairman, John, announced that we are committing 150 billion as banks to finance SMEs. The government has Hustler Fund, whether it goes to SMEs or it goes to parties, it's something different. But it is actually there, and there are quite a number of interventions. But yet, this money actually doesn't get to SMEs. So there is the gap itself, but then also there is the cost of financing. So on average, as you go lower from corporates, you go to commercial, you go to standard businesses, you go lower to micro, it gets more and more expensive. Micro enterprises access credit at around 60% interest rate, about 5% a month or something like that, which is obviously way more expensive. And then there are denial rates. Denial rates are basically somebody trying to get money, then it's denied. Who can take a guess at what denial rate is? The current denial rate for SMEs is? For all businesses, 60%. 60% is actually the current denial rate. That guys try to get money to put in their business, but they are denied. But what happens that part of it is by the SMEs themselves. So financial literacy, what I was saying, is a big deal. Because a lot of people don't know the difference between profit and sales. You wouldn't believe it, but it's actually true. Somebody sells the whole day, goes home, and says, I have made today 10,000 shillings. Goes to the bar with the cash, or is probably an Mpesa, and has a nice time. And then the following day, actually, they don't have the money to obviously run their business. So that financial literacy is an issue. And then there is an issue of formalization. When you go to the banks, for instance, ourselves, we finance people based on the business itself, whether it can make money, whether we can get our money back. And that whole formalization process is actually not there. Some of the things we've done as a bank is that we are running now, we have realized that you cannot support SMEs without being involved in their training, in actually supporting them to understand these things. Yesterday, together with partners, I was actually attending a function where we were launching a program called Upskill, where Upskill has conducted training for 5,000 SMEs. They are trained on everything from marketing to financial literacy to customer service to production to packaging, everything. And yesterday we had about 2,000 of them. And the questions from the audience, you could actually see that there is a real need to support SMEs to grow. So we are running these programs. For instance, last couple of months we were running a program in partnership with Strathmore for women entrepreneurs, and we had hundreds of them coming in to run these programs. Those of us who are running corporates, we really have to invest time and effort to be able to support SMEs. The biggest gap from where I sit is actually knowledge, because as soon as people can access this knowledge, then they become better business people. They become bankable, and then from there, then we can do business together. And eventually, everyone succeeds, and the country does very well.
Wow. So that knowledge gap, and that's why you're here at this conference, just to get more knowledge. Now, you talked about some of these MSMEs being unable to just access that credit, 60%. That's a huge number. So I'd like to direct this question to Rose before we go to our quick fire round. For MSMEs and SMEs, what are some of those tips that you could give so that they can leverage on digital financial solutions?
Right, so I think right now, as we see it, I like the fact that there's a lot of emphasis and there's a lot of attention that's going to the MSMEs, so both from a macro side and even different institutions are paying attention to it. So what I would advise the MSMEs to do is, number one, it's been mentioned, the information is available. So we say today in life, if you lack information, it's not because it's not available, it's because you literally are the one who's not looking for it. So take advantage of the fact that we are now a global village. You don't necessarily even have to go physically to someone to learn. You can actually get very affordable digital courses online. Everyone here is, I'm assuming, and I'm probably sure, is tech savvy, digital native. You can be able to learn a lot. And that knowledge means when you invest the time in it, it matters. We normally say if it is important to you, you'll find time to do it. So that's one. Number two, when it comes to the financial services that are available, there's some biases that we normally have. So probably you'll go to your Instagram, and I'll go back to what Elizabeth was saying. Everyone will just be telling you about a specific type of investment. Maybe you're an SME, and you'll find all your favorite influencers are talking about one thing. Try and avoid that, what we call confirmation bias. Do your own homework and see, does this fit into my lifestyle? Does it fit into my business? Does it fit within what we're trying to do? Because we've also been told about, you're doing this for the longevity. You're not just doing it for now. And that actually can also make a big difference. Number three, you're responsible for your data, so to say. So if you're talking about your business being digital, you need to be aware of the tools that you're using to keep track of your numbers. The tools are available. You can either use your banking tools, mobile money, as we've been informed, and there are many others that you can be able to get for free, even online. So based on what I've just mentioned, it means everything is there. It's just a matter of you taking that leap and saying, I'm going to pay attention to it, and I'm actually going to be able to do it. Thank you for that.
Now we have 2 minutes, so I want us to go to a little quick fire round, and I'll direct a question to each of you and just answer in 1 minute. Then everybody who has questions, just be on standby. We'll have questions after this. So I'll start with the first one, Elizabeth. This is somebody who is, let's say, a 30-year-old, has 10 million shillings, and they're wondering, what should I do with this lump sum? Give them advice. Should I go to crypto now that Trump is coming back?
No, we go to Maldives. Anyway, just joking. So you've got a windfall. Now, windfalls can be your bane in your life. So when you get a windfall, you've got to sober up. The first thing I'll tell you is sober up. It's just a windfall. So once you sober up, then you get proper advice. Please do not go to, especially like friends who are already hawking. It's like, let's say, for example, you get that 10 million, and then you're asking your buddy who just knows you have just got it, what do I do? Okay, I got 10 million. Go to the right people. So find advice from people who are more objective and they have no conflict of interest with what you're doing. Many times it's families who will come and tell you, now you're left by your mom 10 million. I have land. We'll buy you land, things like that. So you avoid that. You sober up, you research, and don't make hurried decision. In life, when you make a hurried decision, you're likely to make a misstep. So I would say, just stay cool. Maybe the first thing, let the money first stay in a very liquid asset like a treasury bill as you look through all the possibilities and draw a new plan, because your life has just changed. It's not the same. So you shouldn't make decisions as though your life for yesterday is the same one today. That's what I would say.
Okay, thanks. So keep calm and then get some financial advice. And you can see outside there, when there's a break, please go and visit those stands. There are financial advisors there who can take you through. Now, Robert, I want you to tell us, what has been your biggest financial mistake?
My biggest financial mistake actually is investing in a business. And I wasn't there. I hired a relative to run it. And I'm a very busy person. And so I could hear, obviously, he's living a nice life. Obviously, I thought he probably has other investments. Long and short of it is that I lost 9 million bob in that business.
Oh, sorry about that. So we forget about our relatives. Okay. Anyway, Peter, so check on them. Now, I have a boyfriend or a girlfriend, and I love this person so much. Should I put them as my beneficiary in my life insurance policy? And then also just talk to us very briefly the difference between next of kin and beneficiary. Important.
Wow, okay. That's a very interesting question. I think the conversations about putting someone as a beneficiary is a very serious conversation. So probably that relationship needs to be a little bit more serious than just a boyfriend or a girlfriend, because you're actually talking about succession planning. You're talking about a family. So possibly the word family needs to come first before you start talking about beneficial, someone who is in your will or in your nomination of beneficiary and all that. Yes, so I wouldn't put my girlfriend in my will or in my trust. I would work hard to graduate her beyond a girlfriend.
Okay, you've heard that.
Yes. Yeah. Now, the difference between a next of kin and a beneficiary is possibly well understood by looking at the different kinds of assets that you have. So there are assets called probate assets and non-probate assets. So probate assets are assets where if I was to pass on and I still own those assets, I would need to go through a probate process. Those are the conversations now happening in the family court to pass on that ownership to the other person. So in most cases, the people who would receive those are the next of kin. So beneficiary are normally recipients of assets that are in a non-probate asset. Like your insurance policy, you would nominate people who would be paid the benefits coming out of that. Your pension policy, you'd nominate who would be the beneficiaries if I'm not there. Your money market account is a trust. You'd nominate who would be paid in my absence. So in essence, that's actually the clear difference between a next of kin and a beneficiary.
Okay, now we're short on time, but I just want to give those two questions. Esther, in under 1 minute, you know, people look at people in the C-suite, Chief Financial Services Officer. Do you have any money problems?
Okay. It's an interesting question. So I wouldn't say I have money problems. I may have money challenges. Yeah, there's a difference. So money challenges is the aspirations I have, the things I want to do. Am I there yet? No, I'm not yet there. There's a type of way I'd like to live and things I want to do. And that requires a little bit more money than what I have today. Because, you know, when you get a little bit more, you want more. So that's what I'm saying. So I don't think I'm completely there. But there's another challenge that comes the more senior you become. The more senior you become, see, now you all know me as Mama Mpesa. If any of you have a wedding and you send me an SMS, what are you expecting? Someone loses a loved one, what do you expect from me? Right. Someone has a baby, what are you expecting from me? Correct. Now, those are the challenges that I then say, it's not a problem, but it's a challenge. Especially if you're someone who wants to support and to work with people. Where do I draw the boundaries? How do I make sure I'm also taking care of myself, my family, my loved ones, and also being able to share? That's a real problem that a lot of senior people face. And I think it's one that's also faced with politicians, right? Because you do have to share, and people see you not suffering in a similar way that they are. So the expectation that you should be able to give a lot more becomes a lot higher, and the resources ultimately are limited.
Yeah, challenges. You know, they say, yani ulituma to 1,000. Really. Anyway, finally, Rose, for SMEs and MSMEs, maybe they're earning 100K, 200K turnover, and then they just get that lump sum. Now, Elizabeth talked about for the individual, for the SME, is it time to just close shop and say, I'm retiring? Or what should I do with that kind of windfall if I get 10M?
Okay, so don't retire. However, remember what Sauti Sol told us. Raha, usijinyime. But on a very, very fair note is, truly, if you've been earning 100K, 200K, and then you get this windfall, you can celebrate. Usijinyime sana useme, no, let me keep this because I don't know what's going to happen tomorrow. You've done a good job. You can set some money aside and celebrate. However, this doesn't mean that celebration is, I used to maybe go out for dinner, but today I'm going to get a jet and take myself to some place. It just means within your means. So what I would advise is this. When you get into that windfall income, we normally say, don't make the next decision when you're super happy or when you're super sad. Because high emotion, low intelligence. So when you're high in that emotional state of ecstasy, your intelligence is down here. So calm down, then make that decision when you're feeling, you know, a bit, let me say, sober. And then I guess you should be fine.
Okay, thanks. High emotion, low intelligence. I know I'm bad on time. Mina, will you give me a chance? 2 questions. Can we field 2 questions? Oh, okay. Thank you. Okay, you've heard 10 seconds. I don't know. This one is from John. Maybe I'll direct that to you, Elizabeth. Is the house that I'm living in an asset or a liability?
Okay. I don't know the house. First disclaimer. But what I know is, if you own it, that is, you have paid off, it is an asset. If it is a loan to the bank, only the amount that you have paid off as capital, not interest, is yours. So if your loan is 10 million and the repayment is still 9 million, 1 million is what you own. So you can decide, is it the bathroom, bedroom 1? That's how it works. It's as simple as that.
Okay, let me just take one more. What's the name of the banking option without a physical address? That's branch from Rose. But just one last one here. when it comes to all the levels, when it comes to policy, corporate entities, social enabling institutions, how do we bridge the gap of awareness individually and jointly? Robert, maybe you can take that in 1 minute.
I didn't quite get it. What is it?
Okay, so when it comes to all the levels that we have to deal with, when it comes to policy, corporate entities, socially enabling institutions, how do we bridge the gap? So it seems to be there are so many like regulations from policy level, there's the corporate, there's the social, so how do we bridge the gap to ensure that we remain resilient?
Okay. Actually, we were just discussing that earlier with John about how when you are running a company, an institution, you have got all these requirements, all these demands from different, obviously, stakeholders. And you almost always have to have a trade-off. You almost have to have trade-off of either time or resources or effort or whatever it is. But for me, how I look at it is what has the greatest gain or greatest good to the greatest number of people. That's where my biggest effort goes to.
Thank you. Greatest gain to the greatest number of people. Thank you so much, Peter, Rose, Elizabeth, Esther, and Robert. Thank you all.